let's get started then. All right, so today we're going to talk about option selling strategies. Specifically, we're going to talk about naked option selling. It's a sore subject for a lot of people, especially brokers. If you've ever shopped around for a brokerage firm willing to house an option selling account, you've probably had a rough time. Most brokerages will not allow their clients to sell options. We at DeCarley Trading, we do. We are fans of option selling, but there's definitely some things you have to keep in mind, and option selling is certainly not the laid-back, stress-free, easy money strategy that some people portray it to be. There's risk and there is reward, but there's risk and there is stress. So we're going to talk about a couple of different approaches to naked option selling. And if you're not familiar with what naked option selling it means, just simply selling options without any risk protection. So for example, selling calls or puts outright without buying protection, without buying a call or put above or below to limit the risk. So in other words, you have unlimited risk and limited profit potential. Okay, if you're not familiar with myself or DeCarley Trading, my name is Carley Garner. I am a broker at DeCarley Trading in Las Vegas, Nevada. And we can be found on social media, Facebook, Twitter, Instagram. If you're there, check us out. My Twitter handle is @CarleyGarner. On Facebook, if you just search DeCarley Trading, we'll pop right up. And if you have any questions or comments about today's class, feel free to send me an email or give me a call. There's my information. And just to reiterate, we are a brokerage service. We are a futures and options brokerage firm. And as I mentioned before, we do specialize in short option trading, which is rare in this business. So keep that in mind as we roll through this presentation. Myself, I am like I mentioned, a broker, a strategist, and an author. I write a couple of newsletters that we email out to our clients with short option trading recommendations. We give very specific recommendations, which options we're selling, when we're selling them, for how much premium, why we're doing it, here's the chart, that sort of thing. Not saying that we're always right. In fact, it's there's definitely some trying times, but that's trading and that's any strategy. You might have seen me in Stocks and Commodities magazine. I write a monthly column, and I also contribute technical analysis commentary to the Mad Money Show with Jim Cramer. I've also written a handful of books on commodity trading. The newest book is Higher Probability Commodity Trading. It was released in the summer of last year, and it is basically, in a nutshell, everything, all the lessons I've learned throughout my career. I started in early 2004, and during that time I've seen just about anything you could possibly imagine, and I'm sure there's still more to see. I can't wait for the next thing, the next shoe to drop. But it's the good, the bad, the ugly, you'll find in that book. And a lot of the things that we talk about today are in the book. So if you're interested in learning more about option selling and probability trading and that sort of thing, it's definitely a good resource, or I hope it is anyway. By the way, it's cheapest on Amazon. Free shipping, you can't beat that. It's a big, heavy book, so you want to go with free shipping. Before we get started, I just want to make sure that everyone understands there is a substantial risk of loss in trading futures and options. It's not suitable for everybody. And when I talk about risk, I'm mostly talking financial risk. But we should also mention there's psychological risk and probably emotional risk and maybe even risk of relationships in your personal life. So before we get started, though, in addition to the risks, I just want to make sure that everyone's kind of on the same page in regards to what option selling is. So let's just take a crash course in option selling. Option selling is not typically well received by beginning traders. And the reason being, it's a strategy that comes with limited profit potential and unlimited risk. On the surface, that just does not sound like a great deal. And besides that, you've probably heard horror stories of account draining losses. Option selling gets a lot of bad press because it can go bad, and when it does, it goes horribly wrong. However, with proper risk management, we believe that option selling delivers optimal odds of success for traders. And again, I mentioned before, that doesn't mean easy money. Just because you're putting the odds in your favor doesn't mean that it's a cakewalk. It just means you're putting the odds in your favor. So it might be a little easier in the long run, than some other strategies, but it's not easy. So the idea of option selling is base hits win the game. Premium collection can be considered a base hit strategy, or at least in the way that we approach it, or the way that we believe you should approach it. It is true that there are some option sellers out there that are swinging for the fence, and that's the thing about trading. Regardless of the strategy, you can be as aggressive or conservative as you want it to be. And we're going to, as we go through this, we're going to show you some examples of different approaches to option selling and how the risks differ, and the rewards may, even if the reward is the same, the risk can be different, and we'll show you exactly what we mean. So home runs typically attract all of the attention, but it's often the base hits that win the game. Egotistical traders are normally not very good option sellers because they're constantly seeking the big one. They want the big trade. They want to talk about it with their friends at work. They want to brag. Option sellers probably aren't going to have a whole lot to brag about in the short run, but in the long run, hopefully they do, and that's the idea. So the difference between buying options and selling options is the option buyers are paying a premium, and that the premium is the price paid for the right to buy or sell the underlying futures contract at the strike price. When you buy an option, you're buying an asset, but it's an eroding asset. Option buyers face limited risk and unlimited profit potential. So if you buy an option for $200, the most you could ever lose is that $200 plus your commissions and fees. But your profit potential is unlimited, and that's attractive for some traders. They like the idea of knowing that no matter what happens, they can only lose 200 bucks, but if something crazy happens, who knows what they could make? They might make 300, they might make 3,000. I've seen, in rare situations, I've seen traders take a couple $100 into several $1,000s in a single option. I mean, it can happen, but it's pretty rare. So obviously an option buyer, when they're entering a trade, they buy the option to enter the trade. And to get out, they have to sell the option or let it expire worthless. Most options do expire worthless, which is exactly why option selling is a high probability venture, or at least it is on paper. And we're going to show you a couple of examples here later in the presentation that might blow your socks off when you look at things. Just because an option has a good probability of expiring worthless, and just because it doesn't mean that there wasn't some turmoil in between. It's just not quite that simple. And even further, just because you sell an option and the futures price never gets to your strike price doesn't mean that it was easy money, because it probably wasn't. There was probably at some point some situation that you were in where you were either underwater or at least losing a little bit of sleep at night. So option sellers, on the other hand, they are collecting premium. They're accepting money in return for the responsibility of delivering the futures contract to the buyer. It is a liability, not an asset, to the seller. The option seller is taking on unlimited risk for limited profit potential. So if somebody buys a $200 option, the person that sells that option to them is taking the other side of that bet. They're collecting $200. That's the most they can ever make, is that $200. But their risk is theoretically unlimited. And again, like I said, most options do expire worthless. So if you sold an option and you held it to expiration, the odds are you're probably going to make money. That said, it's going to be a roller coaster of emotions and account value. Okay, so the relationship between the buyer and the seller is basically that they have the opposite relationship. There's always going to be one winner and one loser. If the option buyer is making money, the seller is losing, and vice versa. If you've ever purchased an option and watched the value erode to nothing, the seller's having the opposite experience. Wouldn't that be nice to sell an option and just watch it erode slowly over time to nothing? It's a nice feeling, and it does happen more often than it doesn't. That's the idea of option selling. We know that more often than not, options erode in value. Now, keep in mind that in today's marketplace, today's environment is a little bit strange. Like, we're seeing volatility levels that are just insanely low, historically low. If you look at the VIX, which is basically the S&P, we aren't now, but last week anyway, we were basically at an all-time low. If you look at the volatility in crude oil, we're near, I can't remember what it was, but like 14 or 15-year lows. I mean, the markets just are not moving, and the options are cheap, and so it's scary to be an option seller right now. And it's probably not the best strategy to have a whole bunch of short options out at this point in time, because volatility will come back. Now, of course, maybe volatility won't come back tomorrow, and maybe it won't even come back this year, but it will come back, and that's the hard part as an option seller, is being patient enough to wait for the volatility, or at least being smart enough to not be in the wrong place at the wrong time. So the idea of the premise between being an option buyer versus being an option seller is option buyers have to be extremely right to make money. In fact, option buyers can be right and still lose money. And this happens if the volatility decreases or if the futures price doesn't move far enough to cover the premium paid. But option sellers, on the other hand, they can be wrong and still make money. And this is because premium erodes, just like a brand new car, when you drive it off the lot, it erodes in value. Options do the same thing. As soon as somebody buys them, they start losing value, and they continue to lose value over time unless something out of the ordinary happens. So the great thing about option selling is you can be wrong and still make money. Where you lose money as an option seller is when you are extremely wrong, and that does happen, and it happens to us. But hopefully, if you continue to put the odds in your favor in the long run, the idea is you're hopefully can ride out those drawdowns and the bad times and come out ahead in the long run. So obviously there's two types of short option trades. There's selling a call, and this is simplifying things. I mean, obviously you can do spreads and all types of different things. But when it comes to naked option selling, you can sell a call, which is bearish, or you can sell a put, which is bullish. And I say bearish and bullish simply because it's easy to label them that way. But in reality, when you sell a call, it's really more of a neutral to bearish. And when you sell a put, it's more of a neutral to bullish, because you don't necessarily have to have the market to go up or down for those trades to work out. For example, if you sell a call, you might still make money even if the market goes up. Again, like I said, you have to be really wrong to lose money on that. And again, it does happen. For example, we've recommended that our clients sell call options against the E-mini S&P recently, and we all know what's happening there. The E-mini S&P is not stopping for anyone or anything. So we have been wrong on that situation, and not only have we been wrong enough for the options to gain tremendously in value, but we are in a losing position. Those types of things happen. As I mentioned, in normal market conditions, the market can really go up, down, or sideways, and you potentially could still make money, as long as you're just not too wrong. So a lot of people get nervous when they're selling options because they're scared that they're going to be exercised. To be honest, if you are exercised, it's a blessing. If you're exercised, it means that the buyer of that option is giving up all the time value, and that's the best thing that could possibly happen to you. Because if you're in a position where it's worthwhile, I should take that back. It's really almost never worthwhile for the option buyer to exercise their option unless we're talking about a market that doesn't have a lot of liquidity. That's a different story. But in a liquid market, it's generally better for the option buyer to just sell their option and take the profit than it is for him or her to exercise the option and take delivery of the futures. So as an option seller, that's probably never going to happen to you, except for if you hold the position to expiration. At expiration, the exchange will automatically exercise it if it's in the money. So don't be scared of being exercised. If it happens to you, it's your lucky day. If it happens to you because you held the option to expiration and your option was in the money, that's not necessarily your lucky day, but it's not the end of the world either. And I'll show you in a couple of examples soon how an in-the-money option isn't nearly as traumatic as it seems. It's not fun, I'm not saying that, but it's not the end of the world. So this is just, in a nutshell, kind of an example advocating why option selling can be such a good strategy to consider, or a favorable strategy to consider. So in this particular example, somebody might be interested in selling a 127 call option in live cattle for $1 in premium, which is 400 bucks. This particular trade would have been profitable had the market gone up, down, or sideways. So the market's right here as this option is being sold. The only way for this trade to lose money is if the futures price is above 128 at expiration. That is the only way that the trade loses money, if it's held to expiration. Now, before expiration, it's possible that the trade could be a loser if the futures price goes up, volatility goes up, or the futures price goes up, or whatever the case is. The option can increase in value, but if you hold it to expiration, the only way you're going to lose is if the futures price is above this price. That's a tall order. As an option buyer, the only way you're going to make money is if the if the futures price is above this price. So you can see there's a much bigger burden for option buyers than there is option sellers. Option sellers don't have to be right. When we sold this option here, hypothetically, we were just saying, well, we think cattle prices are going to go down, or at least we think they're going to stop going up, or at minimum, we think they will stop going up as fast as they are at this time. And this trader happened to be right. But you can see there's plenty of room for error, and that's the beauty of option selling. Options are an eroding asset, so you want to be a seller, not a buyer. Usually. I'm not saying you should never buy options. There are definitely times that it makes sense, but for the most part, you want to try to be a seller. Selling options give you ample room for error, so you don't have to be exactly right. You can be wrong, and you might even still make money. More options than not expire worthless. So being a seller will automatically put the odds in your favor. Habitual option buyers are throwing good money after bad in hopes of hitting a rare home run. And it is true. You will, if you're an option buyer and you buy enough options, eventually you're going to hit a big trade. But if you continue to just blindly buy options over and over and over, you're going to have a hard time making money. The time to be an option buyer is when volatility is low, or prices are at an extreme, or preferably both. But you shouldn't be an option buyer in all circumstances. So the one thing to keep in mind as an option seller, and most people overlook this unfortunately, is option selling is not as easy or not as simple as selling an option knowing that the futures price will probably never hit your strike price, and therefore you get to keep the money at expiration, and therefore there shouldn't be any problems between now and then. Because although option sellers are essentially betting that the price of the futures contract will not exceed the strike price of their short option at expiration, a short option trader can experience unbearable paper losses in the time between the trade entry and expiration. And I say paper losses because they're only losses if you actually exit the trade, right? If you buy them back. That said, if you don't have enough money in your account to finance it, whether it's a funding issue or you're just trading too heavy and you don't have enough margin excess, you're over leveraged, those paper losses will become very real losses. The futures price doesn't have to reach your strike price for massive losses to occur. So you really need to keep this in mind when you're putting your strategy together. Unfortunately, traders are too often focusing on expiration probability statistics, but those can be misleading, and we're going to look at some very specific examples. So there's 3 general approaches to naked option selling, and let's talk about those. All option sellers will have to make the decision to sell quality options with relative proximity to the current futures price for higher premium, or low quality options that brings in less premium but are further from the current market price. So in other words, in English, as an option seller, you're going to have to at some point decide, do you want to sell deep out of the money options that are cheap and aren't worth much, but are far enough out of the money that you're probably not going to have to worry about the futures price ever reaching your strike price? Or would you rather sell a little closer to the money, knowing that the odds of the futures price reaching your strike price are a little greater, but you're going to get a little more premium, and you're probably not going to have to sell as many options as you would if you sold the deep out of the monies to get the same amount of premium? And I'm not going to necessarily say there's a right or wrong answer to that, but we are going to show you what you're looking at in regards to risk, and you might be surprised. So before we start, I want to make sure everyone knows what delta is. Delta is the rate of change of an option or group of options based on a unit change in the underlying futures price. So for example, the delta of a futures contract is 1. That's because for every point a futures moves, the futures moves a point. That makes sense. If the delta is 0.5, then an option will increase or decrease in value half a point for every 1 point the futures price moves. Another thing to keep in mind in delta is it can be used as a rough estimate, and I say rough because that's what it is, it's rough, probability of an option expiring worthless or out of the money. So if you have a delta of 50, that means you can kind of assume that there's a 50% chance that that option is going to expire worthless. Okay, so there are 3 different ways to approach naked option selling. You can sell at-the-money options, meaning that the strike price is going to be equal to the current futures price. So for example, if you're selling we'll just say if you're selling an S&P call, the market right now is at 23.60. So the 23.60 call would be an at-the-money option. If you do this, you're going to collect more premium, because obviously an at-the-money option is going to be very expensive, so you're going to get a lot of money for that, but the delta is going to be really high. So that option is going to have about a 50% chance of expiring worthless, but it's also going to move quickly, right? It's going to be more volatile. It's going to, for every point the S&P futures moves, your option is going to move half a point. So your account's going to swing half as much as the futures market does, and that's quite a bit. As an option seller, that's probably not what you're going for. The other alternative is you could sell moderately out of the money options. It's pretty subjective. Moderately to me might mean something different to you, but we'll just go with it. Obviously, you're going to collect less in premium for that type of a trade, and your delta is going to be lower. And then there's other type of traders who will sell deep out of the money options. They're looking for strike prices that are extremely far from the current market price. They collect very little in premium, and their delta is minuscule. So as a reminder, just don't forget this. Delta is the rate of change in option price per unit of futures price, and it's synonymous with perceived risk and probability of the option expiring worthless. So most people assume that if your delta is lower, your risk is lower, but it's not always that simple. I argue that a low delta risk is perception and not reality. On the surface, one might assume that selling deep out of the money options, remember these are strike prices that are extremely distant from the current futures price, involves the least amount of risk. This is on the surface, this is what most people assume, because the trader is positioned in an option that has the lowest delta and the highest probability of expiring worthless. But this thinking can quickly backfire on anybody who gets carried away or doesn't have the trading capital necessary to employ the strategy. So I'm not necessarily saying that it's a bad strategy. I'm just saying to get away with that strategy, you're going to need plenty of money on deposit, and you're going to need not only plenty of money on deposit, but you're going to need plenty of excess capital, and we'll define that in a few minutes. So keep in mind, deep out of the money options require or at least encourage traders to sell options in high multiples, and this can be troublesome. So if you're only collecting $50 or $100 for an option, you're probably not going to sell just one of them. You might sell 4 or 5 or 6 or 10, and that's where people can get into trouble easily. In normal market conditions, it might work out just fine, and it might work out just fine for several months or maybe even a couple of years. But there's going to be one day where volatility rears its ugly head and those options explode in value. Deep out of the money options attract option buyers when volatility arises, and this causes prices to be bid to abnormal premium levels. So for example, $100 options, especially in a market like crude oil, one day they can be worth $100. Crude oil, let's go with call options because we've all seen crude oil call options do nutty things. I've seen crude call options on one day that are worth 10 cents, which is $100. The next day, they can be worth 7, 8, 9, even 12 cents. So they go from $100 to $1,000 more or less in a day. And that is not that rare, believe it or not. It does happen. Does it happen every day? Absolutely not, but it does happen. And a lot of it is because, especially in today's markets where there are a lot of online traders, there's a lot of people out there with relatively small trading accounts. They can't afford to buy crude oil futures. They don't have $5,000 to buy the futures, but they do have a couple $100 to buy those options. So that's what they go for. They go for the cheaper options, and that way they're bidding the price up because everyone's trying to buy the cheap options. And suddenly those options are priced to ridiculous levels in a very short period of time. So option prices increase on a percentage basis can be astonishing for the deep out of the money options. It's not uncommon to see those types of options increase by 1,000% during volatility spikes. And I'm talking about a day or two. We're not talking about weeks or months. And in addition to that, the bid-ask spread can balloon dramatically due to a lack of liquidity. So when you're going to the deeper out of the money options, there's going to be less people trading them. So when volatility does come, there's less buyers and sellers, and the bid-ask spreads get even wider. I've seen the E-mini S&P balloon to 10 to 20 on a bid-ask spread. That means to buy an option, it's going to cost you $500. To sell it, to buy it's going to cost you $1,000. To sell it would be $500. So we're talking $500 spread. And that's in the E-mini S&P, which is probably the most liquid option market out there, or at least one of them. I mean, try looking at crude oil or natural gas on a big volatility spike. It's really tough to get fair fills if you're in those deep out of the money options that nobody else is trading. A lot of times we just don't think of these types of things until it's too late, until we're in that situation and we have to. Okay, so in a lot of cases, it's the quantity of open positions with higher percentage price changes that poses all the risk during market turmoil, not the proximity of the strike price to the futures market. And this is kind of the opposite of what a lot of option sellers assume. Like we mentioned before, regardless of whether the futures price ever reaches the strike price of the option sellers trading the deep out of the money options in high quantities often they simply can't finance the drawdown and are forced out of the trade with unbearable losses. Selling options in high quantities might work for several months or even a few years, but eventually it will end in catastrophe if traders aren't leaving adequate margin access to absorb the drawdown. And when I talk about high quantities, that can mean a lot of different things. If you're trading a $10,000 account, high quantities might mean 4 or 5 options in one particular market. In a bigger account, obviously it means a whole different thing. But what we try to encourage traders to do is try to keep your quantity down to 1 contract per $1,000 on deposit. Now every strategy is different. Some strategies require that you go beyond that limit because maybe you're doing strangles, maybe you're doing some sort of spread. So there's definitely exceptions to the rule. But the general rule of thumb is you want to try to keep the quantity to 1 per 1,000 or less than that. And you really ideally want to only use about 25% of your account towards margin. And if you're trading with a brokerage firm that offers you span margin, and again, like I mentioned, not all brokers will let you sell options, and even those that do, most of them will charge you extra margin. We don't, but a lot of them do. But if you're going off a span margin, which is the exchange minimums, which is what we charge our clients, you really probably only want to use about 25% of your account if you're strictly trading short options. And I know a lot of you are thinking, well, why would you let 75% of your account just sit there doing nothing? And the reality is, we just went through 13 or 14 slides telling you that option selling provides you with optimal odds of success, but you will never give yourself the opportunity to, make those odds a reality if you just don't have the financing to survive the rounds of volatility. Volatility will come, and sometimes it's only 2 or 3 days. And then the market goes back to normal and life goes on. But if you don't survive that 2 or 3 days of chaos, then you're done. So in order to make sure you're still around to talk about it, using 25% is probably a good idea. So the question I ask you, is it really riskier to sell closer to the money options than it is deep out of the money options? Can higher delta options be safer? And I use the word safe just for lack of better words. Safe is probably not the right word to use in trading under any circumstances. As you all know, we're speculating, we're not investing, so there's no such thing as safe, but it's a relative term. So higher delta options can potentially be safer than lower delta options. And the reason being, higher delta options are going to see a lower change in delta during a volatility spike. So we just pointed out before that the out-of-the-money options have the potential to explode on a percentage basis if volatility increases. But the higher delta options, they will obviously still do the same thing, but not to the same magnitude. So it gives traders a better chance of riding out the wave of volatility. Also, the higher delta options are a little more expensive, so they're less prone to option buyers bidding the prices up illogically. And they're usually a little more liquid than the deep out of the money options. So there's generally, not always, but generally tighter bid-ask spreads in dire situations. And that can make a big difference. If the bid-ask spread is monstrous, 500 to 1,000 bucks on an E-mini S&P in the deep out of the monies because nobody else is trading them, and your option bid-ask spread is only 250 bucks right there, that's, you're talking several $100s in difference just in fill quality. So it can make a really big difference. So just to reiterate, I mean, a lot of you may be practicing option selling strategies at this moment, and you're probably thinking to yourself, well, over the last couple of years, I've sold a lot of deep out of the money options, and everything's going great, and it's just been wonderful. Well, you're right. The reality is, in normal market conditions, it's preferable to have options with distant strike prices. In normal market conditions, deep out of the money short options perform very, very, very well. But where they sneak up and catch people is when the volatility stress comes into the market. When volatility comes back, it's actually the closer to the money options that perform better on a percentage basis. And we all tell ourselves, well, when volatility comes back, I'll just get flat and move to the sidelines. But the truth of the matter is, volatility doesn't come slowly, it comes quickly. One morning we'll wake up and the S&P will be down 80 to 100 points. And instead of dip buyers jumping in and saving the day, it'll just cascade lower. That's how these things are. It just happens. There's no warning, and a lot of times it's not something that you can catch before it gets ugly. To ensure that you can ride something like that out, should it happen, I mean, maybe it'll never happen again, we don't know for sure, but to give yourself a good shot at riding out volatility if it ever comes back, selling fewer options with closer strike prices, it's going to give you a better shot at that. So let's compare a few different strategies and just see how they would perform in a highly volatile market. Now again, I just want to point out one more time, the current environment is unlike any we've ever seen. The volatility is at historical lows, and I'm not talking just the stock market. It's true in the commodity markets as well. So it's a little tricky out there. The options are relatively cheap, the volatility is low. Maybe it'll stay like that for another year, maybe it won't. But when things do change, they will change dramatically, and it will be scary. So make sure that you're not only putting yourself in a position in your trading account that you can survive it, such as we mentioned before, selling only one contract per 1,000 or so in your account, or only using 25 to 50% of your account towards margin, but also keeping these things in mind in regards to quantity. So here's three different ways you might have collected premium in gold before the U.S. presidential election. A trader could have collected roughly $1,000 in bullish premium, meaning selling puts, in three different ways. They could have sold 2 April 1150 puts for $500. This trade would have had a delta of 8, meaning which is a really low delta, meaning for every point that the futures market moved, this would have moved 0.08 points. So it was actually a very low delta. And we could have assumed from that, at that time, the chance of that option expiring worthless is 92%, and those are pretty good odds. Or a trader could have collected $1,000 by selling 5 of the April 1100 puts for $200. The delta on the 1100 puts is 0.03, so that is also a very low delta with a 97% chance of expiring worthless. Also very good odds of success. The trader might have also decided to sell 10 of the April 1050 puts for $100 a piece. The option delta on those is 1, meaning it's minuscule. It would barely budge. As the futures price is moving around, those options wouldn't budge. In normal market conditions, it would seem like, and I say seem because it seems that way, but it's not reality, it would seem like almost printing money. At the time of this trade, gold was at 1280. So the odds of gold dropping from 1280 to 1050 were probably not that great, and they probably still aren't. The position delta is the delta of all of the positions combined. So if you're selling 2 options, you multiply the option delta by 2 and you get 0.16. You'll notice that our position delta also goes down with our quantity. So on the surface, selling 10 of the April 1050 puts looks like the winner. You're extremely far from the money, over 200 points. You have a minuscule delta, whether you're looking at position delta or option delta, and a 99% chance of these options expiring worthless. So on paper, the odds of you making money on this trade are very, very, very good. So let's look and see what really happened. And somebody's also asking, he trades SPX options and a few other ETFs, so he's not sure what's needed for futures options. We actually did an entire class on trading commodity options in the futures markets versus trading stock options, and there's a lot of reasons to trade commodity options. They're generally margins lower. You generally can do it in a smaller account. They are generally available to different types of traders. So for example, in a commodity account, you don't have to apply for special permissions to sell options, that sort of thing. But there you can usually get a lot more bang for your buck in regards to margin versus premium sold. In this particular case, I picked gold because this gave me a good example of premium explosion. Probably isn't the best example of how much premium you can collect per margin. In fact, gold is very highly margined. In each of these 3 strategies I have detailed here, you're looking at roughly 5,000 in margin. The margin of selling the 2 April 1150s is probably closer to 4, and the margin on selling the 10 April 1050s probably a little closer to 5,500. But you get the idea. It's in that $5,000 ballpark. So, and you're collecting $1,000. In most other commodities, you can collect a lot more premium for a lot less margin, but this was a good example of how options can move when the volatility goes up, because the gold was one of the few markets that has seen a big spike in volatility. Okay, so let's see how each of these positions went. So remember, gold started at 1280 before the election, and we had the choice of selling 2 1150 puts, which did become in the money. You'll notice the low here is about 1130. So those 1150 puts went in the money by $20. The 1100s and the 1050s never went into the money. They actually haven't expired yet. They're still open. They're not open trades. These are hypothetical trades, but they still exist. So they haven't expired yet, but it does look like they probably will expire worthless. With that said, the market did get to 1130, and it did look like they were potentially in play, although the futures price never reached their strike price. Okay, so this is a chart of the April 1150 put. So this is the one that was closest to the money, and it did actually go into the money. Remember, I told you the low was 1130 in the futures price. So this 1150 put went in the money by $20. We originally hypothetically sold the option for $5, which is $500. And within a couple of days, this option was going for $20 in premium which is $2,000. So a trader was already immediately losing $3,000 right off the bat. The option, a couple days after the election, was trading 4 times what it was from on November 9th, so it quadrupled in value in a couple of days. And a month later, it was trading 10 times what it was before the election, which is pretty miraculous, 10 times. That's a big move. This trader would have lost $9,000 on a 2-lot of the 1150s that went in the money by $20. Now, obviously, this is not the best example of, something that would make you want to sell options, but I'm just trying to prove a point here. This trader that sold 2 options in a horrible trade lost $9,000. Remember, these options went in the money. Let's take a look at the next 2 options. The April 1100s, if you recall, the April 1100s, we sold 5 of them. To bring in the same amount of premium, we had to sell 5 of them. These options never went in the money, but they didn't quadruple in value. They were worth 6 times as much a few days later. So they gained, on a percentage basis, they gained even more than the 1150s did, and we were holding a higher quantity of them. So we actually would have lost $5,000 on this trade, even though these options were further out of the money, had a lower delta, and on paper had a higher probability of success. These options lost more. Remember, on the previous trade, the loss was $3,000 within the first couple days. This loss is $5,000. A month later, they had gained in value by 13 times for a $12,000 loss. If you recall, in the previous example where we only sold 2, it was a $9,000 loss. Okay, so let's look at the final example. So remember, on the final example, we sold 10 of the 1050 puts. Now remember, the price of gold never got anywhere near 1050. The low was 1130, which is $80 above our strike price. So even though it only got to 1130, the 1050 puts lost $12,500. That trade, they had a 99% probability of success according to the delta, or a 99%, I should say, a 99% probability of expiring worthless, which I should point out, those puts probably will expire worthless next month. However, even though they're going to expire worthless, that trader had to go through a $12,000 to $13,000 drawdown before he got to keep his $1,000. I don't think any of us would want to go through that. And within a couple of days on that 10 lot, he's losing $6,500. Now remember, in the first example, the trader that sold 2 contracts of the closer to the money options, he was only losing $3,000. The trader that sold 10 of the deep out of the money options, which seemed on paper to be just printing money, lost $6,500 in a couple of days. So the point is, just because on paper these options look like it would be almost impossible for the futures price to ever hit the strike price, that doesn't mean that the options can increase in value. And the deep out of the money options that are cheap, like this is $100, we sold 10 of them for $100, they have the ability to absolutely explode even if the futures price never gets to the strike price. It can be very dangerous, and it can be something that pushes small traders out of the markets before they ever get to enjoy the benefits of option selling. Luckily, most option selling ventures are not like this. This is one of those examples where obviously it would have been better to be an option buyer than a seller. These option buyers did very, very well. But I just wanted to show you how options behaved and why it isn't always, things aren't always what they seem. The risk isn't always what it seems. Most traders use delta and probability to measure risk, but they can be really misleading. So here's kind of a summary. The smallest loss was actually the trade that on paper had the lowest probability of winning and the highest position delta. So on paper, a trader might have thought, well, that's the riskiest trade. Why would I do that? But in reality, during times of high stress, it was the least risky. Now, keep in mind, this was an abnormal situation. Under normal market conditions, this trade would have performed better. But what I'm trying to prove to you is, although obviously normal market conditions are going to occur more often, even if they do, if you don't survive the abnormal market conditions that occur once every year or once every 2 years, it's not going to matter. If you wipe everything out on those abnormal conditions, then then it's not going to do you a whole lot of good. The point is to find some sort of balance. You know, maybe it's somewhere in between there. Maybe it's the 5-lot 1100s. You have to find what you're comfortable with and what fits your style and that sort of thing. So there's not necessarily a right or wrong answer, but you just have to understand that just because you're selling an option that will probably never be in the money doesn't mean that it's a low-risk trade. It's not that simple. So in conclusion, things aren't always what they seem to be. Complicated math or fancy software is merely giving us information based on what has already happened. It cannot predict what will happen. Thus, probability calculators and delta should be taken with a grain of salt. I know there's a lot of software out there that will tell you with precision to like the 8th decimal point what the probability is of an option expiring worthless. But I just showed you in those examples, even though we were going off rough estimates, delta is a rough estimate. But who cares if, I mean, maybe it was 93% versus 92%. It doesn't matter. What they're giving you is a snapshot of today. Tomorrow can be different. We all learned that on election night. The reality of November 8th was different than November 11th or even November 10th. Things can change on a dime, and the option calculator that you were using one day to calculate your probabilities is going to mean absolutely nothing on the next day if something changes. So just understand that it's a tool and it's not something to bet the farm on. So if you walk away from this class with anything, I hope it is that you understand sometimes there's more risk in quantity than there is proximity to the market. So having an at-the-money option isn't necessarily more risky than having a whole bunch of deep out-of-the-money options. In other words, you can lose more selling out of the money options in high quantities than you can lose on 1 or 2 in the money options. Also, if you're selling options and even if you start with selling in a moderately out of the money option and unfortunately the market goes against you and you find yourself in a situation where your option's in the money, meaning that the futures price is at, near, or a little beyond your strike price, obviously that's not ideal, but it's not a reason to panic. That said, having an uncontrollable explosion of delta is reason to panic. So if you've got a couple in the money options, I'm not saying put your head in the sand and forget about it, but don't panic. If you're the type of person that you're selling 20, 30, 40 options in a small account, you really should be, that's when you should panic. Just rethink your priorities as an option seller and be careful. First, I want to actually thank you for coming. I appreciate all of your support. I hope that you guys learned something that you can walk away with and it'll help you in your trading. If you have any questions or anything, feel free to contact us and be sure to visit us at DeCarleyTrading.com. And if you liked what you heard today and you want to hear more and you're interested about commodity trading and higher probabilities and option trading, my book is available at any book outlet, but it's cheapest on Amazon. It's Higher Probability Commodity Trading. And you will find us at DeCarleyTrading.com. You can also shoot me an email or give me a call if you have any questions. And I see there's some questions here in the box. I'd like to go through and answer some of these. Somebody's asking if we accept Canadian clients. Unfortunately, at this time, we do not. It's not our choice. It's Canadian regulations that prevent us from doing that. Hopefully, in the near future, that will change. Another question is, why not spread instead of naked? Everybody has a different style. I tend to prefer selling options naked under most circumstances, but it just depends. I do agree that in some situations, spreads make sense. Spreads definitely take some of the stress out of things, and it eliminates the unlimited risk factor depending on how your spread is organized. We actually, if you're interested in our take on spread trading, we do a lot of, we've done some spread trading webinars on DeCarleyTrading.com. If you go to the Learn section at the top and then look for videos, we have about 20 or 30 videos, and a handful of them are on spread trading. So we do that sort of thing. This particular class just happens to be on naked option selling. Okay, somebody's asking, what's the closest day till expiration you'll take a position, and what's the longest? As far as option selling goes, the word of wisdom is that most of the premium erodes, or the most quickest erosion, I should say, takes place in the last 30 days. But if you try to sell an option with less than 30 days on it, you'll find that you end up getting a little closer to the money than you're probably comfortable with. So we generally like to go somewhere around 40 to 60 days to expiration with our short options. We don't mind going a little over or a little under, but that's kind of what we're shooting for, is 40 to 60 days. I probably wouldn't go much less than 30, because then you start getting really close to the money to get any premium to make it worthwhile. But every situation is different. Okay, I guess seems like we've answered all the questions. So again, if you think of something that I missed or you have a question, let me know. Send me an email. We'll make sure you get taken care of. I appreciate you coming out. Thanks, guys.